Have you ever wondered why truly wealthy Americans don't keep large amounts of cash sitting in bank accounts? It's a key difference in how they manage money. The approach to cash storage is a fundamental part of a wealthy person's financial strategy. It's not about distrusting banks, but rather optimizing capital. For most people, a large bank balance represents security. But for the wealthy, letting money sit idle in a checking or savings account is actually considered a major financial misstep. The core strategy is diversification. Wealthy individuals ensure their cash is actively working for them, rather than being passively stored due to several key factors. One of the most immediate reasons is the low-yield environment offered by traditional bank accounts. These returns barely move the needle for significant wealth. Savings accounts offer minimal interest, often less than 1%. This small return is insignificant compared to the potential growth available in other investment avenues. More critically, while your cash is earning almost nothing, it is simultaneously losing purchasing power due to inflation. This is a quiet tax on stagnant savings. Inflation is the constant, underlying pressure that erodes the value of currency. For large sums of money, this erosion can represent a substantial loss over time. If inflation is running at 3% and your bank interest is 0.5%, your money is actually shrinking by 2.5% every year in real terms. The wealthy cannot afford this leakage. Instead of holding cash, the wealthy prefer assets like real estate, stocks, and bonds that have the potential to appreciate, thereby outstripping inflation and truly growing their capital. Investment opportunities present a clear path to capital growth that bank accounts simply cannot match, driving the wealthy to constantly deploy their funds. The wealthy are focused on maximizing the returns on their capital. Every dollar is seen as a seed that should be planted to yield a greater return, not kept dormant. Their financial management shifts from a focus on preserving immediate liquidity to one of aggressive capital growth, using investments to build long-term wealth. Another consideration for those with significant holdings is risk mitigation, especially concerning the limits of federal insurance. The Federal Deposit Insurance Corporation, or FDIC, insures up to $250,000 per depositor, per ownership category per bank. Any amount exceeding this is uninsured. To mitigate this risk, the wealthy diversify their holdings across multiple institutions or opt for safer, higher-yielding alternatives like money market funds, rather than keeping huge sums in one account. Tax strategy plays a crucial role in managing large wealth, and investment returns often offer better tax treatment than bank interest. Long-term capital gains from investments are typically taxed at a lower rate than ordinary income. This is a powerful incentive to hold appreciating assets. Conversely, any interest earned from bank accounts is generally taxed as ordinary income, which can be subject to the highest tax brackets for the wealthy. In conclusion, the decision by wealthy Americans to avoid keeping large amounts of cash in banks is a calculated strategic financial move. Wealth is built and maintained by ensuring capital is actively invested to combat inflation, maximize returns, manage risk, and optimize tax efficiency. Money is a tool for growth, not storage. This perspective on money management is a key differentiator between being affluent and truly wealthy. Always look for ways to make your money work harder for you.